So we can say that the net profit is an increase to the capital of the owner because it is a return to the owner. So the net profit has the effect of increasing the balance of the owner's capital. So it would be then it would be credited because it increases capital. If it was on the other hand a loss, we would be debiting it because loss has the effect of reducing the owner's capital. If there was a drawings account, which we learned in the previous chapters, drawings, we would have to close that off as well and transfer it into the capital account just to so that we know at the end how much is actually the balance that of the owner into the business. So drawings account is always debited because it kind of like reduces the capital or the owner's equity. So to close this off, we would transfer the amount to capital. So to transfer the amount to capital, we would credit drawings and we would be debiting at the capital account. Whatever balance we have remaining, we carry down the balance, which would be the balance of the cap of the owner as at year end, and we'll take it to the next year. So this is how the net profit affects capital account. So at the year end, as we can see, we closed down the sales, purchases, and all the income and expenses accounts. So what balances would be left in our accounts at year end, which would be taking forward to next year? So this is generally a list of assets and liabilities and capital that are left after we have incorporated the profit into the business. So generally, this is the trial balance after we have prepared the trading account and profit and loss account. And here we can see fixtures, debtors, creditors, stock, bank, cash, capital. All these balances are only either assets, liabilities, or capital. There are no balances for income and expenses account, which we did in chapter 4, because all the income and expenses accounts, they have been integrated and merged to find out the net profit figure, which was then added into capital. So this is a very condensed uh, account of summary of the accounts that are remaining, and this would then be used to prepare a balance sheet as at that date. So we can kind of like also understand the trial balance can so the trial balance, the capital amount, and the cash account, asset account would be the same, where we have expenses and account as well. It's only going to be it's the capital accounts balance which would have been changed. So the trial balances before we make the trading profit or loss account would have all balances of assets, liabilities, capital, and income and expenses. Whereas the trial balance that we would prepare after the trading and profit and loss account would only contain balances of assets, liabilities, and the capital account. Hope you understand and go through the review questions, and we will then use this trial balance or different example to prepare a balance sheet as at a particular time. Thank you.